VDHG or DHHF. These are two similar Australian ETFs, but they're not quite the same. We'll compare the pair and highlight the key similarities and differences to hopefully help you out if you're weighing up between the two. First off, an ETF is an exchange-traded fund, which is basically a big basket of stocks and assets spread across multiple companies, sectors, and even countries that are then rolled up into an all-in-one investment solution on the stock market. We did a quick video for those who might be new to ETFs, so make sure you check that one out if you need a bit more info. Vanguard's VDHG and Betashares DHHF are two popular Australian ETFs given their wide diversification. They are similar in some ways, but there's also some slight differences, which we'll go through now. First, let's look at their asset allocations. VDHG is Vanguard's Diversified High Growth Index ETF. It has a 90% allocation to growth asset classes and a 10% allocation to income or defensive assets. Here's the full breakdown of the ETF. You can see there's 36% to Australian shares and 54% to international equities. VDHG's 10% of defensive assets comes in the form of bonds and fixed interest. As part of this blend, VDHG has 6.4% exposure to small cap assets and 4.9% to emerging markets. Interestingly, the product is completely made up of other Vanguard ETFs. So basically, it's a Vanguard ETF of Vanguard ETFs. It's a mixture of their Australian Shares Index ETF, VAS, tracking the performance of the top 300 companies on the ASX, Vanguard's International Shares ETF, VGS, capturing large and mid-cap international assets, excluding Australia. Then there's VGAD, which is the same, but hedged to Australian dollars. Then there's VBND, which is Vanguard's Global Aggregate Bond Index ETF, which is also hedged to Australian dollars, but tracks global bonds. VISM gives exposure to small companies listed in major developed countries. Vanguard's Emerging Markets Shares Index Fund is next. And finally, Vanguard's Australian Fixed Interest Index ETF, VAF, provides a small offering in Australian fixed interest. Now, let's roll on over and look at DHHF's asset allocations and sniff out the differences. Betashares Diversified All Growth ETF is completely comprised of growth assets, which makes sense given the name. It's the first of its kind in Australia on the ASX. DHHF is divided up with 37% invested in Australian shares and 63% in international equities. Naturally, you can also see the emerging markets and small cap market percentages are also slightly higher for DHHF, given it holds no defensive assets like VDHG. DHHF has a 7.6% exposure to emerging markets and just over 8% in small caps. Again, both numbers are slightly higher than VDHG as you'd expect. Unlike VDHG, which is a pure Vanguard product, Betashares DHHF features a mixture of different products from 3 different providers. It's a mix of A200, which is Betashares' own ETF tracking the top 200 companies on the ASX, VTI, Vanguard's Total Stock Market Index ETF, which tracks the full US stock market. Then there are 2 State Street Global Advisors ETFs, SPDW, which follows the developed market outside of America, and SPEM, which covers emerging markets. The main takeaway is that DHHF gives you a larger exposure to international, small cap, and emerging markets compared to VDHG, but this comes at the cost of the defensive assets which are held in VDHG. So there's no right or wrong here. It all depends on your risk tolerance and what you're actually looking for in an ETF. Now we move on to the MER, or Management Expense Ratio, of these ETFs. This is basically the management cost charged to the investor expressed as a percentage. VDHG comes in at a MER of 0.27%. DHHF is cheaper on paper, advertised at 0.19%. But all is not quite what it seems. Without going into the details too heavily and causing everybody to fall asleep, there is a tax drag associated with US domiciled funds holding non-US assets, such as SPDW and SPEM, which are included in DHHF. Some have calculated this tax drag to effectively raise the MER of DHHF up towards 0.28%. That's 0.01% higher than the MER of VDHG. So basically, there is no difference between VDHG and DHHF in terms of management fees after taking into account this subtle tax drag associated with DHHF. One last thing we'll look at is hedging to the Australian dollar. In short, hedging is a strategy where you take steps to offset the influence of currency fluctuations on your investments. This isn't necessarily a positive or a negative thing and probably isn't a deal breaker with either of these ETFs. Again, it just depends on what you're looking for. VDHG has 16% hedging to the Australian dollar through its allocation to VGAD. There's another 7% hedged in its bonds allocation in VBND. This ties the ETF closer to the performance of the Australian dollar more so than DHHF, which has no hedging to the Aussie dollar whatsoever. Basically, it's another somewhat defensive aspect of VDHG to consider. At the end of the day, both VDHG and DHHF are great products for those looking for an all-in-one diversified ETF on the Australian stock market. It's easy to see why they are growing in popularity and so often compared. The main difference between the two is in VDHG's 10% allocation to defensive assets, while DHHF has a higher exposure to international markets and features no defensive assets whatsoever. There are other slight variations in effective MER and hedging as we've discussed, but in all honesty I would expect these factors to be quite small in influencing either ETF's performance over the longer term. The best thing about these two products is simply the competition they provide one another. It's only a good thing for us as investors and customers to have options and choices of where to put our money, and to have the likes of Vanguard and Betashares competing for our business. The decision between the two ultimately sits with your own risk tolerance and investment strategy. Hopefully this comparison has spelled out some of the similarities and differences between VDHG and DHHF. Please leave a like if you found it useful, or subscribe and check out some of the other personal finance content we have laying around on the channel. Until next time.